Welcome to Alpha Wolf's Den. There's a lot more to a company than just their earnings. Alpha Wolf's Den, we're searching for those intangibles. We're looking for clarity and enlightenment. You can have a great product or a great service, but without great vision, without passion, without a plan, how many of those will be successful investments? Alpha Wolf's Den is all about getting to know the leadership, and not so much all of their successes, but their failures. And how did they address those failures? How did they bounce back when they faced challenges? Do they have a big cash burn? What's the mission? What's the total addressable size of the market? We want to separate fact from the fluff. We want to know insider participation. We want to know what the long-term objectives are and the tactical initiatives that are going to get them there. Investing is more than just looking at earnings reports. It's understanding how debt can impact the company, or the size of the float, or the amount of shares outstanding. All of the things that can be obstacles, conflicts, challenges. We're looking for solutions. And we're ultimately looking for the hidden gems. That's what Alpha Wolf Den is all about. I hope you enjoy this interview, because this is a company that I think could be one of those hidden gems. Okay, I am very pleased to welcome Steve Rhodes. This will be our second interview, actually. Unfortunately, you didn't get to see the first one, but this is a redo, and I appreciate Steve coming in to do this a second time, but very important. I love what Steve does. I think we had a great meeting last time, and Steve, why don't you just tell us a little bit about yourself and a little bit about Trendlines?
Well, thank you, Tim. It's good to be back. My name is Steve Rhodes. I am the co-chairman and co-CEO of the Trendlines Group. As you can tell from my accent, although we're an Israeli company, I'm originally from the States, originally from Chicago, but living in Israel for 36 years now. And I formed the Trendlines Group 14 years ago together with a friend and business partner, Todd Dollinger, in order to enable us to pick the very best early stage startups, especially here in Israel, and to build great companies from them. So that's kind of the short version.
Okay, so essentially, so there's two areas that you focus on, right? There's agriculture and medical devices.
Right. When we first started investing, we made a decision that we wanted to invest in areas where the markets are enormous, the challenges are big, you can make a lot of money, but also where you can do a lot of good. And so we started in the medical device area. And 3 years after we started, we then branched off into the agri-food technology area as well. And they're great areas to be in. Okay,
so you mentioned Todd. Now you guys actually have a 35-year history, right?
It's true. Yeah, we've been working together since, 30 years. We've been working together since 1991.
Okay.
So, amazing. And we haven't killed each other yet.
Yeah, that's pretty impressive. So You actually have 3 locations. You've got China, Singapore, and Israel.
Correct. That's right.
Okay. And a
Is-
team of about 60 people that work directly for Trendlines.
Correct. So Israel's the home. It's where we started. A number of years ago, we identified lots of opportunity in Asia and started operating primarily a business development operation in China to assist our companies in doing deals and raising capital. And a few years later, we added Singapore as a third base of operation.
Okay. So you've got 62 companies in the portfolio. When I first met with you, I think you guys had like 58 companies, right? And you were working on, I think, a spin out of one at the time.
Correct.
And that has occurred, right? That spin out happened.
Yeah, just a month ago, we announced the exit of our company, Orthospin. We sold it to Johnson & Johnson, actually to their DePuy Synthes subsidiary. It was a great exit. We had a 12x return on investment and I think an IRR of 165%. So it was a good day for us.
So Orthospin is this robotic device that essentially, if you break a leg or you have a bad break where you've got to go in and adjust these little screws all the time, right? And it actually can be pretty painful to keep setting the bone, I guess, is what's it's doing, right?
What they're doing is actually lengthening it over time. And so they have to make adjustments, I think, 4 times a day to 6 struts. Up until now, it's always been done manually. And as you said, because it's done manually and it's only done 4 times a day, the increments, the stretching can be painful. You're stretching the tissue, and it's also very easy to mess up. You know, 4 times a day, 6 struts in 90 days. That's hundreds and hundreds of adjustments, and it's easy to understand how you could either miss some or get it wrong. This is completely robotic. The doctor programs it, tells it how to do it, and then the extensions are done gradually throughout the day. So instead of having steps 4 times a day, you have lots and lots of very, very small steps. And so it's painless. We have FDA approval for the product.
So you got 510K clearance on this.
We have 510K clearance on it. And it gives J&J, I think, a huge advantage in the marketplace because everyone else is selling basically the same commodity product. And this is a much better patient experience. It eliminates error. It lets the doctor know what's going on a real-time basis. It's just a much better way to treat the patient.
So how long from the time that you found this company, how long to take it from where you found it and then take it, you know, what I guess what I want to understand is the value add that Trendlines brings to their clients, to the companies that you're looking at.
So in terms of value add, you know, we were approached by an entrepreneur with a brilliant idea. We decided we wanted to invest in the idea. We formed the company together with him. We actually are almost always the first money in. This particular entrepreneur already had another company that he was running, so we didn't. He didn't come in as the CEO. We went out. The first thing we did was hire a CEO. Of course, we provided the capital to get the company up and started. The company sat in our offices for its first 3 years. We surround the company, as you said, with a large team of people who supplement the company's own team with market research, business development, marketing communications. All of the capital that the company raised, we raised for them, together with them, of course, but we acted as their unofficial investment banker. We like to say that we are the largest non-compensated investment bank in Israel. We don't take anything for that work. We sit on the board of directors. We help with strategic issues. Actually, in this particular case, we were very deeply involved in the technology as well. Early on, we identified issues with the original idea, and we brought in some of our technology people
and
we got deeply involved in making some changes to the technology. So we were very deeply involved from the beginning all the way through to the exit and negotiating the exit.
So from a proprietary patents, so forth, you guys established the patents on this.
Right. The entrepreneur came to us with the original idea, but we made sure that the patents were strong. We helped file them. We actually assisted in upgrading the technology and developing new patents. We take a very holistic approach. We understand that you have to get a lot of things right in these young companies. And often the entrepreneurs come to us with limited experience in various aspects of company building. They may be brilliant inventors, but they may never have run a company. So we not only invest in the technology, but we invest in the marketing, in the legal side, the patenting, everything about company building.
Right. So I think that's very interesting, because just through experience over my 30 years investing, I think one of the things that I found is that sometimes the founder or the inventor or the idea guy can be, I mean, he's great in the beginning because he was the idea guy. But as the company starts to scale, a lot of times they are ill-equipped to run a company, and they don't seem to recognize that. And they can, right, they wind up being the downfall of the company, because they just don't recognize that they don't have this. They want to be the guy that takes it to the finish line, and they're ill-equipped to do so.
Our business model was developed based on the company that Todd and I had before we set up the Trendlines Group. We had a consulting business for 16 years here in Israel, and we consulted to literally hundreds of Israeli startups. And what we saw again and again was that when they failed, it wasn't because of bad technology or lack of market need, it was because of poor execution. So when we started the Trendlines Group as an investment company, we actually merged our consulting practice into the Trendlines Group, told our consultants, from now on, your job isn't to sell hours, your job is to help our companies succeed. And so we try to compensate for those skills that they may not really have or may not come with, like the business development, the negotiations, the legal side of things, the governance, in order to help them get to the finish line.
So when you're doing the financing or helping with the financing, is that through private investors? Is that through, I mean, how are you pulling together that financing?
It's a variety. We'll talk to anyone. We have venture investors who come into our companies. We have angel investors, high net worth investors, family offices, and strategic investors. In the case of Orthospin, for example, the primary investor in the company was actually Johnson & Johnson. Prior to the exit, we interested in J&J and the technology. They expressed an interest in it very early on. And so they came in as an investor in the company through 2 rounds before the exit.
That was kind of risky though, huh? A little bit. Going to J&J and saying, hey, look, we got this thing here. And I mean, what's to stop J&J from saying, that's a great idea, I think I'll do it myself, right?
Yeah, but they don't do that sort of thing. We talk a lot to the corporates. We have relationships, and that's a big part of what we do, is we talk to the corporates all the time about our companies. Even before we invest in them, we as part of our diligence process, we will talk to the potential acquirers to make sure that they're really interested or that there's really a need. You have to be careful, of course. We make sure that we have strong IP, but we also know that a company like J&J can be trusted. And when they come in, they're coming in because they're interested, not because they're looking to steal the technology. they would obviously like to get it on the cheap, and that's a different story. And a negotiation and a management, a risk management issue. But we have a lot of strategic investors in our companies from all over the world.
So when you're I mean, I love the fact that you're very focused. You know, medical device technology and agriculture, which are two massive industries, right? So the total time that you were with Orthospin, how long of a time frame was it before? I mean, from concept to exit.
I think it was about 6 or 7 years. The slide, at which I can't quite make out, I think it tells the year that the company was established. It was 2014.
Oh yeah, I see it. Okay, 2014, exit 2021. Okay.
Okay, so 7 years is actually pretty good. It's not unusual that for these companies it can take even longer than that. This was a company that, although it had FDA clearance, had not yet begun selling product. And so it was pre-revenue. In some cases,
and you stayed with them for the entire 7 years. Time. So there are some, I guess I would say, investment groups that have like a predefined amount of time that they're gonna, you know, it's like they want to get in, they want to get them to wherever they want to get them so that they can spin them out and, you know, boom, move on, right? You're in for the whole haul.
But one of the great things I think about our model as a corporation and not as a fund is that we don't have any artificial time limits placed on us, so that we're not forced to get out of a company prematurely. We can, as I said, in Orthospin, we were in for 7 years. The year before, we sold a company called ApiFix. I think that we were in ApiFix 10 years before the exit. So we can really stay with a company and continue to work with them and adjust also the level of our involvement based on need.
Okay. So let's 62 companies in the portfolio. Let's talk about the maturing of your portfolio right now.
We're in a really interesting place, I think. We started investing back at the end of 2007. As I said, we typically start the companies we invest in, and it takes a long time when you go in that early. I think they say for venture, the average time to exit is 10 to 12 years. And if you think about it, we're coming in pre-venture, really. We're coming in at a formation stage. So you start out with a portfolio 14 years ago that was all immature, very young companies. Today, we probably have 20 or so companies that are in advanced stages, meaning that they are in revenue, they may have FDA clearance. They're companies that we think are moving forward in a very significant way and building a lot of value. That it's also reflected the fact that the portfolio is much more mature on average than in the past by the amount of capital that we're raising. Last year in 2020 rather, we set a record raising $43 million in follow-on capital for our portfolio companies. This year, we beat that record, raising over $50 million for our portfolio companies. The size of the raises is increasing on average, as are the valuations. And that all points to a portfolio that's becoming more and more mature, getting closer to commercialization, and we hope to some sort of an exit.
Do you think it's also, I mean, is it possible that it's also just the market climate, right? I mean, we've been in a bull market for quite a while, so you've got a lot of money. You had a really easy Fed interest rates, right? I mean, everything has been pretty good there. Do you think that's played a big role in the amount of capital that you're able to raise?
It certainly hasn't hurt.
Right.
It certainly hasn't hurt, but the fact is that the companies that are raising are farther along on average than they've been in the past. Lots of companies that have completed clinical trials, that have received clearance, that are selling product and scaling up. And so it's a combination. Certainly the fact that there's a lot of money out there looking for investment opportunity is great. On the other hand, something we've seen over the years is that even in down periods, gaining in or getting investment for early stage companies hasn't been that, I won't say it hasn't been hard, because it's always hard, but it hasn't been as hard as we feared it would be during downturns. Part of that, I think, has to do with the fact that during some of the downturns, when for example, when the stock market turns down and people have nowhere to put their money, the stock market is going down, and if bank interest is non-existent, then investing in young companies is an interesting approach, because you're sort of investing to grow out of the cycle. These companies, even when you invest in one of our companies, it still could take years before the exit occurs. So you're not looking for a quick return. So
Right.
people, in some ways, see the investment in startups as counter-cyclical.
But I would imagine that some of the companies that you get involved in, even though I know you're not looking for a quick return, I would imagine there are times where you get a quick return, right?
We had one exit 8 months after we started a company. That was exceptional. I don't think that's going to happen again anytime in the near future. But when an opportunity comes along, we always look. We're managing a portfolio, and it's a portfolio approach. So we're actively looking at the question of portfolio management and risk management. And if an opportunity presents itself, we won't say no automatically. We will consider it at any stage.
So how do you, number one, how do you find these guys? I mean, how do you find these companies? I mean, I'm not asking you to give me your secret sauce, right? I mean, but how do you find them?
It's not a great secret. It's a lot of hard work. We have 4 people on staff who are full-time responsible for deal flow. They're looking at a variety of places. They're out talking to entrepreneurs. We're out promoting ourselves to the entrepreneurial community. We have a good reputation in Israel and in Singapore as best of class, and so we attract entrepreneurs, but we also participate in conferences. In addition to all of the outreach we do to entrepreneurs, we go out and talk to tech transfer offices in academic and research institutions. Not all of the companies that we start come from entrepreneurs. Sometimes we license a technology from a university, from a hospital, from a research institution, and we start the company without an entrepreneur. We have a third and more unusual source of deal flow, which is we invent the technologies ourselves. We have an in-house innovation group, and they're doing research all the time. And sometimes they come up with something smart, and they bring it to us, and we will invest in it. Similarly, we do co-creation. We have a venture fund in partnership with the Bayer Corporation, the large German pharmaceutical and agrochemical company. And on several occasions they have come to us with a problem, and we've gone out and found the solution to that problem and started a company based on that co-creation model. We do a lot of outreach to attract entrepreneurs. We have a monthly newsletter that goes to almost 20,000 people. In fact, anyone who's watching this video is invited to go on for a website and sign up for the newsletter. We talk about what we're doing, and we try to attract deal flow. And I should even mention that we've even invested in 5 companies where the inventors were US-based.
That's what I was going to ask you. So it's interesting to me. I know that Israel is very, very innovative, right? So I kind of understand you going out to Israel, because there's a lot of it seems like to me, especially in the tech and the software realm, there's a lot of Israeli-based companies, right? Startups that are but I also know that there's a lot of startups in the US, right? So I was curious as to why Israel, right? Why not the US? And are there plans at some point maybe to expand to the US or provide this in the US? I mean, it sounds like you already are providing it, right? You've had 5 people contact you from the US. So
we only invest where we have offices. I'll start from that because our business model is to be deeply involved.
right.
We want the companies that we start to actually be physically located in our offices for their first 2 or 3 years at least. We have laboratories here, we have clean room here, we have, but we also have our whole team here surrounding the companies and supporting them. So we want the companies themselves to be here. We theoretically, at least, we're indifferent as to where the technology comes from. So if a US inventor comes to us with an idea, so long as they're okay with our setting up the company in Israel or in Singapore, we're okay with investing. In the past, we've talked about setting up additional offices. Actually, the US is one place where we probably wouldn't set up an investment office. Not because there aren't great opportunities in the US, but because I think that there's just a lot of competition for the deal flow in the US, and I'm not sure that our competitive advantage would really stand out in the US the way it does over here. On top of which, we get lots of great support from the government of Israel and the government of Singapore when we start a new company, and that's something that also makes it very attractive to invest here. We get great leverage, non-dilutive funding from the governments of Israel and Singapore.
Okay, that makes sense. Right. So no chance of a investment office in the US. Highly unlikely.
Well, certainly not an office to invest under the current model.
Okay.
It could, we discuss about twice a year, should we set up a business development office in the US? We've always come down on the side of not necessary. We get to the US in normal days, at least, probably every month, someone from our organization is in the US. And so we just haven't seen the need to have a US based person, but you never know what will be in the future.
Right. Okay. I mean, I think I mentioned to you that the challenge with, I think maybe for investors, I think there's a couple of challenges for investors, is there's a whole lot to wrap your head around with trend lines. I mean, essentially what you guys are is you are investors and you are, very good apparently at picking out good and early investment ideas and then helping those models grow. But those are a lot. There's 60 companies to try and wrap your head around, right? And that's one challenge. And then the other challenge is, I look, at least for me, I look at it and say, Steve and your partner, those are the guys that I read, the profile. You're very involved. You're both very involved in every deal that you do, right? Is the company set up? Are you set up in a way that, knock on wood, God forbid, anything happens to Steve, how is the company set up to continue to move forward?
Well, the funny thing is that we often get asked, how do you have 2 CEOs in a company? Because it's an unusual model, but from that perspective, we have built-in redundancy. If something happens to one of us, we have a second guy who's already involved and can just step up. But we also have a great management team. We have a phenomenal team of people who are really leaders in their field. Dr. Nitsa Kardish, who heads our agri-food investing, is one of the top people in the world in the agri-food investment space. Nitsa's invited to investor conferences all over the world to talk about what we do. Barak Singer, who heads our investment activity in Israel, it has been around for many years in investment banking and in investment. So it's a great team, and there's a lot of depth. But Todd and I are involved, and we're involved because we liked it. We enjoy it. It's great fun what we do.
Well, you're building successful companies. I mean, who wouldn't love doing that? And then you're also helping people become successful entrepreneurs, CEOs. Who wouldn't love that? And throw on top of that, you're making a nice return for your investors. So that's like a win-win-win to me, right?
Absolutely. It's when it works, it's a tremendous feeling. And I would even add one more aspect to it, which is that the companies that we're building not only are making lots of money for us down the road, but are also doing real good for the world.
They're changing the world. They're doing better things for the world.
The company that you threw up now, Phytolon, has amazing technology for producing completely natural food colors without the agriculture. Today, half of the food colors that we use are synthetic, they're carcinogenic, they're very unhealthy. The other half are natural food colors, but you have to grow thousands and thousands of acres of beets or other vegetables in order to extract those colors. And if you think about it, it's really wasteful. You're taking arable land that could be used to produce food, and you're using it to produce a color. There are other problems with the food colors as well, but just focusing on the sustainability aspect of it, we're able to produce the exact same color. I mean, not similar, not synthetic, but exactly the same color in a fermentation process that's a completely industrial process. So we do it in a much more efficient way. In fact, Phytolon just is in the process of completing a big study on their environmental impact and the carbon savings that they will generate from this process. Right. It's a company that's getting tremendous interest from the industry. They've got paid pilots from half a dozen or so of the biggest companies in the world in the area of space of food and food ingredients. And this will be an enormous company, I believe.
So right. Yeah. I mean, if you're taking up acres and acres and acres of land to basically grow something so that you can extract the color from it, nobody's eating it. It's just getting the color squeezed out of it, essentially. Right. Yeah. That instead you could be growing food that's actually going to be consumed.
Going to be feeding people. Sure.
Right. So that makes and that was founded in 2018, right? The funding was 5.8 million.
Right. Very exciting. They're in the process of scaling up. And again, when you ask about what is our involvement or our contribution, this is a company that was based on technology that we licensed from a university here in Israel. We searched for and recruited an outstanding CEO, a young man who's brilliant and doing a great job. We recruited the chairman for the company, an American who had previously been the CEO of $1 billion US company in the ingredient space, and then became the chairman of an Israeli ingredient company that was exited. So we've really been deeply involved in creating this company. And that touches also on your question about, so how can someone get their heads around trend lines? You have 60 companies. How do I understand what you do? Part of it, I think, is to understand the model and the processes, what we do and how we build these companies. And part of it is to look at the companies, but I don't think you need to look at all 60. You can look at a tasting menu, either by just randomly selecting companies off of our website and looking at them and digging in. In our corporate presentation, we identify some of our more advanced companies, and people could just take a look at those 8 companies or 10 companies and say, wow, if those, I mean, I'm not supposed to say things about valuation, but you look at any of these companies and I believe these are all companies that could be worth more than Trendlines, than
Entire
Trendlines.
market cap.
We're trading at about a $60 million market cap today. And, the exit we did for Orthospin, the company was sold for $80 million. But some of these companies are probably worth a lot more than that even.
Now, so let's talk about the exit here. I'm sure it varies, right? But
yeah.
I mean, is there a target that number or multiple that you're looking at that, if we can get this multiple, that's where we exit? And is it a complete exit, or is it, an exit and you keep a piece? I mean, like I said, I'm sure it varies, but what is the goal, I guess?
We've had 10,
right?
we've had 10 exits to date. The average return on investment in those exits has been 9x.
Okay.
The average IRR has been 175%. As I suggested before, we are opportunistic. So if something comes along, we will always look at it. We like getting 9, 10, 12. In Orthospin, it was a 12x return on investment and 166% IRR. We want to get those big returns. But if something comes along and it's serious, we will consider it, because not considering it is also a risk. You don't know what's going to be. We're not prophets. We can't predict what's going to be in the future. I think the returns that we've had have ranged as low as 2x and probably as high as 15 or 20 on the exits.
Okay. And so I guess when you're looking at the companies and they've got, incredible tech, but tech changes very rapidly, right? I mean, things change very quickly. Sometimes, I've seen things where I thought, wow, that is really amazing. And that is just going to be huge. And then, like 2 months later, there's something that comes out that just completely wipes that out. It doesn't even matter anymore, right?
Right.
So when you're looking at these things, and because things change so rapidly, you've mentioned a couple of times now that when you've searched for the CEO, you brought in an amazing CEO. What's the most important thing to you with companies that you have in your portfolio? Is it the leadership that you have? Is that what you find?
It is the leadership is the most important thing. We need someone who plays well with others, who can work in partnership with us and with his or her other stakeholders, shareholders, participants in the company. I mentioned before that in Orthospin, the technology when we sold the company wasn't the same technology that was in the company when we started it. It's important to have management, to have leadership that understands the importance of being able to pivot, to update, to admit that something isn't maybe the ultimate solution, and that there are better solutions or better ways of doing things. At the same time, one of the advantages in the markets that we're in is that although you're right that technology advances quickly, maybe not as quickly in our areas, in our space, as it would say in software, in the internet, or in cyber. Remember that to bring a medical device to market, you have to not only develop the product, but you have to do clinical trials. You have to get regulatory approvals, and all of these things take time. It's not to say that there isn't this competitive risk. We occasionally have on one or two occasions had to shut down companies because we were surprised to discover that someone leapfrogged us. The good news is that, as you've said, we have a big portfolio, and so we spread the risk among a lot of companies, and we know that not everyone is going to succeed.
So when you're, one of the things that it makes your system so successful or more successful is the fact that you're discovering these companies very, very early stage, right?
Right.
and then you're helping them. I mean, you're helping them grow. You're bringing in the support that they need to continue to grow in a healthy manner, right? So when is it that, how much time do you give a company or an idea before you say it's not working and we're done?
That's a really good question. We meet on a monthly basis to review every company in the portfolio and to review their status and how they're doing and where they're at, and to ask the question, the existential questions: are we still in the company? The fastest we've shut a company is after 3 months. That was an outlier. But there are also companies that we've stuck with for 10, 12 years because we believe that there was a lot of potential. I'm very deeply involved in a portfolio company today where basically 6 or 7 years ago, we kind of stepped away from the company, partly because they had big investors who we thought would take the lead. But they got into trouble, and 2 years ago, we re-engaged with the company. The company is 11 years old, and we re-engaged with it and basically turned it around, almost like a restart. And today I'm the chairman of that company, and we've raised a lot of money, and the company is poised to have a great 2022. So we stick with it as long as we believe that there's still potential.
Okay, and that's and I mean, go ahead.
Actually, I said we stick with it so long as we believe that there's potential, and so long as we believe that we have a contribution to make.
Okay, so 3 months was the quickest shutdown. That's pretty quick.
I'm not sure it's something to be proud of, although I guess in some ways it is.
So, well, in some ways it is, right? I mean, if you recognize it quickly, I mean, it's just no different than buying a stock and going, wait a minute, maybe I made the wrong call here and I need to get out instead of riding a 10-year decline, right? I mean, so I mean, sometimes you just got to cut bait and move on.
Right.
So what typically do you find is the main reason that you have to shut down?
The main reason at the end of the day is the management. And it's a big issue. We every time we shut down a company, we do a postmortem process where we bring in everyone who was involved in the company, from the deal flow stage and the approval stage through the company itself, and we ask ourselves, what should we have done differently? What can we learn from this experience? The first question we ask, of course, is, did we make a mistake investing in the company? And if we did make a mistake investing in the company, how can we try to avoid that mistake in the future? Then we ask, okay, we made the investment, maybe we liked the investment, what went wrong? And we analyze, if there was a technology problem, did we get involved fast enough? Did we identify the problem quickly enough? But more often than not, the conclusion is there was a problem with the manager, and we try to move quickly when we see management problems, but it's not always easy.
Right. Okay. That makes so much sense to me. And that is the challenge, because a lot of times, even as a regular investor that's in, first of all, a lot of companies, you can't even, if you're a retail investor, you have no shot at talking to management, especially if they're of any size, right? Where the retail investor actually has a very competitive advantage is in the small micro cap space, because not only are the CEOs willing, they want to talk to you because they want to get their story out, right? And that changes as they become more successful, right? They become bigger companies. All of a sudden, they don't have time to you because they're now going to be talking to the fund manager analyst that's, going to write a report on them. So that's where actually the retail, I believe, has the advantage is, look, nobody's looking at these stories. Nobody's talking to these guys because the company's too small, has maybe a very small float. A big $10 billion fund can't even buy shares in the company. They just have to buy the whole damn company, right? I mean, so there's a lot of opportunity there. Part of the issue, though, is you meet CEOs that are very good at telling stories. They're very good at selling the sizzle. They are absolutely terrible at strategy and execution, right? They're really good at raising capital. They can raise a lot of capital. They can dilute the shit out of shareholders for, a lot of years, but never actually make any money. And that is, that's where you got to look at it and say, okay, wait a minute, as an investor, number one, has anything, significantly changed fundamentally, right? Or is the thesis still intact? I mean, does it make sense to continue to hold an investment that is declining for, at some point you got to say, wait a minute, this guy just doesn't ever seem to bring it, or they're hopping from the one hot, what was hot to the next hot thing, right? They go from being a cannabis company to a Bitcoin mining company, right? That's a little bit of a red flag, right? I mean, keeping an eye out for trends or changes, I think is very, look, being too focused is a bad thing, I think, right? I mean, it's good to be focused, but you have to keep an eye out to what's happening in the world around you, right? So one of the things that I often like to do is I like to ask CEOs kind of off the wall, out there questions, because I want to see if they're at least open to, like NFTs, right? And augmented reality, stuff like that. When you start asking, if you thought of a way to implement it, and they start like looking at you like you got two heads, and they're like, I don't know about all that. Now, I'm thinking of one company in particular, they're a book company, right? Books, children's books.
Okay.
And I'm thinking to myself, okay, I mean, they're putting up some great numbers, right? I think COVID had a lot to do with it because people are ordering books and reading and stuff. But I brought up NFTs and augmented reality. He's a Texas guy. He's a good old boy. He's like, yeah, Tim, I don't know about all that, but if you want a good company that's growing at 30%, I like, okay. But that actually is something that is very fit right into his, and that's where things are going to go. I mean, with entertainment. So the fact that he was not, I mean, he just shut me down and cut me off, was like, okay, that's great. It's not for me. I just think this guy's too focused, right? But then there's the guys that are going from, like I said, a cannabis company to a Bitcoin company. That's a little off, right?
Yeah.
I mean, you stick in the space.
We do, we're always, as you can tell, we are in our own way somewhat entrepreneurial, and we're always thinking about how we can build the business more. We started in 2007 with medical devices. We added agri-food technology in 2011 as a second focus area because it fit very well into our mission and into what we're doing. Today, over the last 5 years or 10 years, we added our Trendlines Innovation Labs, which is an in-house innovation group. A few years ago, we set up some venture funds where Trendlines is the GP, investing in later stage companies, still in the same areas, the same problems, but later stage and a slightly different business model. And one of the things we talk about a lot these days is climate and the whole environmental issue, and especially because our agri-food portfolio has an enormous impact on climate change potentially and on carbon. These are companies that are improving the way agriculture is done and reducing the the carbon footprint, increasing the sustainability of agriculture and food production. So that leads us to talk about climate, and should we be looking at climate as an area per se, or should we just be focused on our agri-food investments as our climate? So we do look at new things, but they're always adjacent when we talk about new areas. We're building on our core strengths. We have this great management team and the staff of 60 people who have basic skills. A month ago, someone came and offered to merge with us with a business that had nothing to do with our business. And and we said, thanks for the offer, but it's not for us. We're focused on the one hand, but we do look for opportunities on the other.
So I'm thinking about the company and the fact that because as I look out, I see a lot of sectors like robotics. I think is going to continue to be huge as more capacity, more capabilities with the technology that we have, smaller. I think that's going to continue to be a trend. And then I look at your and you've got robotics in your medical, and then I look at agriculture and I think autonomous vehicles. I mean, that's definitely coming. Electric vehicles. I'm already seeing electric farm equipment, right? And then drone technology with, I mean, there's just a lot happening in agriculture, in technology as well, right? I mean, it's just Absolutely.
It's a revolution what's happening in agriculture today. And it's happening. You mentioned, so robots, we have a company that has developed a robot for harvesting, for actually doing all the tasks that are done in greenhouses, from the harvesting to the pollination, to the thinning, the pruning. The robot works 24 hours a day, 7 days a week. And not only is doing all of these tasks, but the robot also at the same time is collecting data. And that's the other big trend in agriculture today, is gathering data. You can identify the robot as it goes down the row, looking at the tomatoes to harvest them, can also identify if there are diseases on the tomatoes, if there are other problems. And that's something that just dramatically reduces cost and increases productivity. You mentioned drones. One of the companies on the screen now, AgroScout, has essentially is an AI company that provides agronomy services to farmers around the world. We did a study with a major corporation whose name I can't mention, but everyone listening knows them in Latin America, with potato growers. We found that using the AgroScout technology for early identification and accurate identification of diseases and pests, we reduced the use of agrochemicals by 40%. We increased yields by 10%. So that's tremendously valuable for the growers, and it's very low cost. So these technologies are really improving the way we farm.
And AgroScout was started when?
Probably 2017, 2018.
Okay.
It's a young company. We're up to 30 employees. They did about $600,000 of sales this year. They'll multiply that by a factor of I don't know what next year, but this was really their first year of sales, and they had pilots here with some enormous food producers who wanted growers to use this product in order to lower the use of chemicals.
So with a company like that, let's just say as for your exit, it doesn't always have to be a buyout of, it could be taking them and putting them on the exchange themselves, right?
Yeah, sure.
Doing an IPO.
Absolutely. A company like AgroScout that's scaling rapidly, that has really cool technology, that's expanding into additional markets. They started with the potato market. Today they do potatoes, and they've added corn, tomatoes. They're going into corn and soy. And they can do lots and lots of crops. They can do it all over the world. And basically their market is 500 million farmers. So it could be a huge company in its own right, or it could be a very attractive acquisition target for a big company.
So a huge company in its own right. I mean, you guys, have you taken any public to IPO to US exchange? Senior
Not
exchange?
in the US. We've taken two companies public in Tel Aviv in the past.
Okay.
Both of those deals worked out really well. In the end, both of those companies were acquired by US acquirers. But we don't rule out taking companies public in the US in the future.
Okay.
Just need to get them to the right place.
Right. You just have to get them to the right scale, right?
Exactly.
Look, I don't want to take a whole bunch more of your time. Let's talk about a couple of more. So the needleless neurotoxin delivery for overactive bladder.
Right. So overactive bladder is a condition that affects millions of people. And in severe cases, the treatment today is going into the bladder through the urethra and injecting a neurotoxin, which we commonly call Botox. Botox is a brand name, but using a neurotoxin, injecting it into numerous sites in the bladder to essentially paralyze portions of the bladder wall and reduce the activity of the bladder. It's an office procedure that takes maybe a half hour. It's pretty painful, all these injections in the bladder. It's also not that pleasant, but it's effective. What our company Vensica has done is developed a technique for delivering the same neurotoxin to the bladder wall without the use of needles. And we've signed a strategic partnering agreement with we've signed a strategic agreement with the German pharmaceutical company Merz, which is a producer of the neurotoxin. Under the agreement, Vensica has the exclusive rights to distribute their neurotoxin for this application. So essentially, the company has transitioned from being a device company to a drug device combination company, which increases their value dramatically. They sell the whole solution, not just a piece of it. We just completed a $15 million raise for the company. One of the investors in the company is Laborie. Laborie is a large medical device company, European-based, and I think this company could be enormous. It's a big market, and we have the right solution. A painful procedure that takes 30 minutes today is going to be a 5-minute painless procedure in the future with this device.
So is this something that the patient would they have this at home, or is this they have to still go to the doctor?
They still have to go to the doctor. It's still an office-based procedure,
but no pain.
But it's painless and it's very rapid. Instead of 30 minutes, which is also good for the doctor, because the doctor can increase throughput in the office. So the economics are good for everyone. It's painless for the patient. It does the job better.
So it goes from being a procedure that I'm like, man, I really do not want to go into the office for this because it sucks on every level, right? I mean, it just hurts. It takes 30 minutes, but now it's a 5-minute procedure and it doesn't hurt.
Right.
Yeah. That would be a huge, if I was the patient, that would be like, oh my goodness, this is the most amazing thing in the world, right?
Exactly.
Yeah.
Exactly.
Okay.
Why wouldn't you want it?
Listen, Steve, I get it. I think it's a fantastic company. I want to talk about the chart here real quick. So this is the chart, and I want to make sure everybody understands. TRNLY is the symbol. It's traded on the OTC. From a technical standpoint, the stock has been in a downtrend since 2017. However, It has kind of been in an uptrend since 2020. So actually, you're kind of coming to this squeeze point. There's actually something very significant happening from a technical standpoint for the tech guys. Now, this is the weekly time frame. In other words, each one of these candles represents a week, but on the weekly time frame, you're getting what's called the golden cross. The 50-week moving average just crossed above the 200-week moving average, which for for technical traders, that's a big deal. So it's the golden cross. When you cross to the downside, that's the death cross. So that is actually a positive thing on the daily time frame. So actually you had the death cross on the daily time frame, the 50-day cross below the 200-day, but now it actually looks like it's trying to scoop back up. Here's the issue with the stock. It trades extremely thin. That's why you have all of these gaps. Are there any plans, Steve, at some point maybe to uplist to a senior exchange?
There are no plans to do it.
Okay.
But again, we are constantly evaluating our options. We actually considered dual listing on the Tel Aviv exchange earlier this year, and in the end didn't do it. So we look at questions about how we can increase the trading, how we can get more visibility for the share. You and I met at an investor conference in the US. We have been very inactive in the US for the last 3 or 4 years, but we feel like it's time to be back out telling our story in the US, because I think that we're at an inflection point, an important inflection point in terms of the company's history. So I would never say never, and I wouldn't say we're not going to uplist, but there's no plans at the moment.
Okay. I mean, that is going to make it, that is going to make it more challenging. Because of the fact that there just is not a tremendous amount of volume. It makes it very, very tough to trade the shares, right? Let me just pull this up here real quick. When you're extremely thinly traded, how many shares are there fully diluted, Steve?
There are about 16 million 80. If you translate it into ADRs, our primary listing is on the Singapore Stock Exchange, where we have about 800 million shares outstanding, fully diluted. I translated into ADRs because each ADR is backed by 50 of the Singapore shares. Singapore loves penny stocks. So in Singapore, the share is traded today at around 10.5 cents. In the US, it's at $3.90. So it's roughly 50 US shares. It's 50 shares, Singapore shares in one ADR. So if I translate the number of shares outstanding into ADR, it's 16 million ADRs.
So just as a quick reference for you, so you can see not only has the price been declining, but the volume has been declining from 2017, right? I mean, you can see that clearly. It's just, and when you're trading on average, and this is for a week, 5.5, 5,500 shares, it's going to make it incredibly difficult for anybody to build any kind of size, right? And not only that, but okay, I can get in and buy as many as I want. How the hell am I going to get out if there's no volume, right? That's the challenge. I think you have a phenomenal story. And I think you guys show that you execute, right? And I think you've got a maturing portfolio, which you should be, I would think, in getting to the sweet spot where things start to really happen. So the timing, it seems as though, is right, but this is going to be a challenge for you. I mean, I
agree completely. We're fully aware of that. I think the only way to to turn that around is for us to perform, to show a consistent performance. The Singapore exchange is a primarily retail exchange, which is dividend focused. We've never paid a dividend, but in June
I was going to ask about that.
in June of this year, we announced for the first time a dividend policy that we're committed to. And so I think if in the future we continue to perform and show increasing valuations in our portfolio, and we also start distributing dividends, I think that the market will, I hope, I shouldn't say I think, I hope that and believe that the market will wake up to us.
Right. Okay. So a dividend is something that, which is good to know, especially with the maturing portfolio, right? So.
And you know, the other thing is that today we're trading at a 40% discount to NAV. If there was a lot of volume, and the market knew who we were, I suspect that the discount wouldn't be so great, and so the opportunity wouldn't be as good. Investors who came in a year ago, as you're showing, they've made money, at least on paper.
Right, and actually, you're at this inflection point where this is what's happening. It's like a coiled spring, right? I mean, you can see how it's narrowing here, right? It's only going to get narrower for so much longer, and then something's going to happen. It's either going to break to the upside or it's going to break to the downside, right? But for I mean, what is always the technical guys will look at and say, this is the dominant trend. The longer the trend, the stronger it is, right? But once you break that dominant trend to the upside, that's what's called the trend reversal. And it could be the beginning of, let's see, going down for X amount of years. Now we could be looking at, we're just going up for X amount of years, right? So this actually, this point that it's at right now is very attractive from a technical standpoint. Okay. Steve, this is a fantastic interview. I really appreciate you taking the time to do this a second time.
It was so much fun the first time, Tim. I was very glad to come back.
Well, I'll tell you what, I want us to stay in touch. I am going to be involved in the stock. I don't know how involved. It's like I said, it's difficult to build any kind of size in a stock like this, but I love your story, and more importantly, I love what you guys do. I love the fact that you find you said it early on in the beginning of this. We partner with people that have problems, and then we go out and we find solutions. And I love that. I just think that is an awesome business model, right? You find problems, and then you go out and you find solutions. And what more meaningful can you do, right?
Sure, for sure.
And it's in two big spots: medical, better health, and agriculture, which, we could go on and on about that, because I think we're missing a lot of opportunities there. We have a lot of problems. There's a lot of hungry people in the world, and for some reason we can't seem to figure it out. Hopefully we will at some point. I
hope so. But there's a lot of challenge, and the challenge is an opportunity for us. So that's okay.
Yeah, no, it's fantastic. Steve, if anybody wants, do you guys have a investor alert service for the company?
We do. We try to really be as transparent as we possibly can as a public company. We have an investor alert service that notifies investors every time there's an announcement to the exchange, as well as sending out a monthly update.
Okay.
We also have a more detailed monthly newsletter that includes news about our portfolio companies, things that aren't necessarily newsworthy from the exchange perspective, but are indicative of what's happening in our portfolio companies. And people can just go onto our website, trendlines.com. They can sign up for both of those. and we try to provide a lot of information. There's information about every one of our portfolio companies on the website.
So I think there's a couple of takeaways here. Number one, if you're watching this and you are an entrepreneur that has a really good idea in either the medical device or ag industry, and you want a very comprehensive, complete team as a partner, not a bad way to go. At least, maybe put some feelers out, right?
We're open for business.
You're open for business. And then as an investor that maybe has a longer time frame and and some patience, I think this could wind up being a big winner, right? I mean, as the story, you are now focusing on getting your story told in the US. So,
That's right.
maybe that volume profile will change. We'll see. We'll have to see. But I think if you get the story out, I think if people become more familiar, there's a very strong possibility that could happen, right?
Absolutely. And as you said, Tim, we're very accessible. I can't respond to every email we get, but if I can't respond, then our IR director, Shira Zimmerman, responds. And I get to the States in normal times, at least 5-6 times a year. I'm hoping that 2022 will allow us to travel. And we love to talk to people about what we're doing.
Perfect. Steve, thank you so much. I love the story. And we will stay in touch. Maybe we'll do an update, down the road. And that's it. Thanks so much for taking the time, man.
Thank you. And very best wishes for 2022 and a lot of health in the year.
Yeah, same here. Stick around for 1 minute because I want to share something with you. I'm going to just stop the recording here.